Hello, and welcome to Portfolio Matters Weekly Update, week 34. Now, Richard is currently away sailing, so we're happy to welcome again Stuart Owen, who is substituting for Richard. And before we get into it, Stuart will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Thank you, Stuart. First of all, the economic data we've had this week. Well, it's been quite a quiet week, actually. We're recording this late on Friday afternoon, and we have just had a statement from the Fed after the Jackson Hole meeting, I believe. And Powell is talking about beginning tapering this year, although he was characteristically equivocal about starting and saying it would depend on jobs data. But the Fed is talking about tapering the QE this year. Okay, data we've had. So UK public sector borrowing for July came in at only 10.4 billion, which was well down on the 21.5 billion we borrowed in June, and that was actually below expectations. So that's good news, although obviously public sector borrowing remains very elevated. In the UK, we had retail sales for July, which fell by 2.5%, which are well down on June and massively below expectations, which were for a rise of 0.6%. We've then had a number of flash PMIs for August. Now, bearing in mind, we are still in August, so these are estimates. And UK flash PMI for August is 55.3, which is well down on July with 59.2 and below expectations. But obviously, we have had the resurgence of the COVID Delta variant this month. So it's not necessarily terribly surprising that PMIs are coming down, and that should pass. Now, one thing that is in the news is that various car makers in the UK and elsewhere around the world are cutting production. Toyota have announced that they are going to cut UK car production by 40% because of the chip shortage. So in July, UK car production fell 37.6% year on year, which was well down below on June and well below consensus forecasts of only minus 12%. So car production has fallen heavily, but hopefully that's a temporary phenomenon which will pass when the chip shortage passes. In the Eurozone, the flash PMI was 59.5, which was just down on July and in line with expectations. So Europe continues to do well. In the US, the flash PMI was 55.4, which was down on July and down on consensus expectations. But the US has been suffering from the Delta variant. So how much of that is just transient? Now, also in the US, we had month-on-month home sales for July, which were up 1%, which is a nice bounce from the minus 2.6% we saw in June. And we'll show you a chart shortly. Durable goods orders in the US were down slightly and 0.1% in July. And in June, they were up 0.8, so that's quite a large fall, but they actually beat consensus expectations. The expectations were for a larger fall. And we also had some quarterly data. Now, US corporate profits were absolutely astonishing. In Q2, they rose quarter on quarter by 9.7%. And that is in addition to 4.5% in Q1. And they massively beat expectations of 2%. So we are seeing unexpected strength in corporate earnings. And one of the things we've discussed in many weeks on this podcast is the fact that we are seeing strong input price inflation and wage growth. And surely at some stage, corporate profit margins are going to be squeezed. But as yet, there is no evidence of that. Now, one number the markets found reassuring was Q2 GDP growth, which came in bang on line with expectations, and that was 6.6%, up from 6.3% in Q1. So, of an overview, the US economy continues to grow well. And if we then go and look at a few charts, so this is the EU composite PMI, flash for August, and that remains strong. The UK one is coming off, but we are seeing lots of supply chain disruptions, wage growth. As you'll be aware, various supermarkets are warning that they are having trouble stocking up because of supply chain issues. So there are a lot of temporary factors going on. And in the US, the PMIs are really coming off very strongly. Although there are so many temporary factors in the US as well, we'll just have to wait and see how this develops. US home sales had a small bounce and are returning hopefully to trend. But as we've seen in previous weeks, very high house prices in the US are putting off buyers. Stuart.
Well, here's a new topic for people to think about, the state of the Chinese bond market. I think it's quite an interesting topic because as a wildly important economy, but still half capitalist, half managed, I think its approach to how it handles defaults is going to be a very big transition and big issue for them. So here's a chart showing Chinese bond defaults have hit a record high this year. A few years ago, 16, 17, 18, defaults of about 20 billion yuan per year. That's now up to about 60 billion. Now, to some extent, this is almost good news in that bonds are no longer being supported, manipulated, and perpetuated, but the reality of lending and the risk of default is becoming evident. But there's one aspect of this which I think is going to be a particularly difficult issue to deal with, and that is the fact that quite a few of the defaults are now in China's SOEs, that is state-owned enterprises. Now, you might think that these would be better backed by the government, but on the other hand, they may also be in legacy industries having greater difficulties. So this will be very interesting to see how the courts and how the government allows defaults to work out. Now, this issue of defaults might be becoming even more extreme as there's some emerging evidence that there might be a credit crunch looming for Chinese companies. We all are, I think, very aware of the building boom that's gone on and the risk of ghost villages, ghost towns, but also over-expansion in basic industries, and some of the reality of the economic support for those ventures is going to be coming out. In July, banks were issued with a directive to stop lending to heavily indebted local government-backed ventures, but the consequences of that were immediately pretty clear, and so that directive was immediately reversed in August. Now, one particularly notable example of this emerging situation in Chinese debt markets is the fact that short sellers are able to bet against some of these bonds, particularly via Hong Kong, where companies like Evergrande, the world's largest property developer, have listed bonds, and hedge funds are betting against them. Keith has pointed out a very interesting bit of data from the Bank of International Settlements that's warning that there may be concrete signs of a financial crisis ahead in China. The chart here shows the debt service ratios difference from the trend in that data. So companies on the left here, including Hong Kong, Turkey, China, have increased their debt service ratios, i.e. taking on more debt more faster than usual. And so they're at risk of of a crisis. Typically, I think, did you say, Keith, about this is a 3-year lead to a financial crisis?
Anything above the dotted line shown on the chart, basically, that gives you a risk of a financial crisis. And you'll see,
of course, this would be no surprise. I think every country that has developed fast has typically gone through a financial crisis. It happened in Japan, it happened in Korea. So a lot of people have been expecting it at some point in China. They've always managed to put off the evil day, but this is some early evidence that perhaps it's coming home to roost.
Yes, but also I would add, Stuart, that the Bank of International Settlements is saying that debt service ratio is above 1.8 times the trend, indicate a 50% chance of financial crisis, and China is at 5.1, so way above that warning line.
And further evidence of that is there appears to be emerging tightness in credit conditions. Here we can see the credit impulse in the green line and the 6-month impulse in the white line, both of which suggesting a tightening of credit conditions.
Absolutely. So it would seem that China are aware that credit conditions have been too loose and are now trying to rein everything back in, but too late. The one thing I would say is that China's a managed economy, and they will have done their absolute best to stop these state-owned enterprises from defaulting. And the fact they are now defaulting in larger numbers suggests that they've run out of options. And you wonder whether these are the first symptoms. This is the tip of an iceberg. The trouble is, it's so opaque, the Chinese system, we just won't know. But my experience of the great financial crisis is that, the first symptoms should be taken very seriously, because you've got financial systems are so opaque. There's a chance be a cascade as credit conditions tighten because you have a few defaults, and we've got no idea how bad things really are. Now, one thing we've talked about a few weeks ago was the EU carbon trading scheme, and we were talking about the very sharp rise in the price of carbon credits this year and how we thought that was politically unsustainable. Now, one thing I missed in that discussion was the knock-on effect of high carbon prices on inflation. I saw a presentation from the Macro Strategy Partnership during the week talking about how carbon credit prices will push up prices in the EU and lead to cost-push inflation. And the first thing to note is that as you add renewables to the energy mix, you increase the cost of electricity. And actually, the cost increase is really quite stark. If you look at this chart, on the x-axis, it is the share of solar and wind in the electricity generation mix. And on the y-axis, it is residential electricity prices. And you'll see that going from 5% to 25% electricity, 25% renewables, increases the cost of electricity by about 50%. The Macro Strategy Partnership are explaining this in terms of the intermittency of renewables and how you also then need to have backup power plants to provide base load. Or in the case of the UK, we are now investing in battery systems in order to try and store intermittent renewable electricity. All of that costs a lot of money. And
Keith, one small thing to point out on this topic is that there are actually quite a few green energy companies listed in the UK that would benefit from this. Companies like Greencoat UK Wind or Bluefield Solar actually have half of their revenues are index-linked renewable subsidies, and the other half is the electricity price. So if both of those are being pushed up, they're actually a little bit of an inflation hedge with a reasonable running income of around 6%. So just to highlight that to people as a positive from that story.
Well, that's very interesting, Stuart. So you're saying that if the gas price, let's say, goes up and that leads to rising electricity prices, then Greencoat Wind benefits from that as well.
Well, that's right. Their revenues are half from subsidies, which are RPI linked, and half from the electricity price. And if that electricity price is being set at the margin by the gas price, then they benefit on that other half. Now, quite often they have power purchase agreements, so there's some smoothing and some averaging, but the power purchase agreements are heavily influenced by the gas price.
Interesting. Thank you. So Man Group Strategy Partnership are saying that if the EU carbon price hits €100, then that'll add 15% to the price of steel, 65% to the price of ammonium fertilizer, and 70% to the cost of cement, all of which are basic inputs. And so you will see cost push inflation in Europe. And we saw this chart a few weeks ago when we were talking about EU carbon prices. And this year, there will be a big shortage. And the expert on the EU carbon trading scheme, Lawson Steel, is expecting the carbon price to go well north of €100 later in this year, to the point where the EU will have to step in and allow more carbon credits into the scheme. Otherwise, the price will just go through the roof. And he thinks that is politically unacceptable, so they'll just have to change the scheme. But the point of this discussion is that if we go ahead, the EU goes ahead with this carbon trading scheme as it is, and the EU carbon price goes very high, you are going to see cost push inflation in a lot of basic industries because they all produce a lot of carbon dioxide. Okay, Stuart.
Right, picking up on something that's been discussed in the past few weeks of Portfolio Matters, we had a bit of a downer on the US dollar, and I know Keith is negative on the euro as well for long-term structural breakup reasons. So I was thinking to myself, well, look, if I was a sovereign wealth fund manager of modest proportions, where would I look to invest? Where else can you be if the dollar and the euro, the two largest currencies in the world, are unattractive? So I had a quick look at some basic statistics, inflation in various countries, current account balance, and also crucially, the net government liabilities. So basically the stock of debt or assets in a country. So you might think, well, what about Japan? It's about 10% of the world economy, very low inflation, always got a good current account balance. But on the other hand, it has net government liabilities of 130% of GDP. Australia looks a bit better, basically in current account balance and low inflation and very little debt overall. But the standout is Norway. If you're running a small sovereign wealth fund out there, you might want to consider the Norwegian kroner. Current account balance in surplus, no doubt due to oil. And look at that. Net government liabilities are minus 330% of GDP, i.e. their sovereign wealth fund, and at very low inflation. So the difficulty with currencies and where to park your money is it's an ugly contest. No one looks particularly attractive, and there's very little out there of any size.
Very interesting. If faced with a choice, Stuart, would you be buying Norwegian kroner?
It put a gun to my head, yes. But of course, what are you actually going to buy in Norwegian kroner?
Well, but the thing is, if you buy Norwegian kroner, aren't you essentially buying a currency that's backed by equities? Because they've got 330% of GDP in I suspect a large amount of that is in US equities, isn't it?
There is no alternative, Keith.
Mhm.
Tina, she rides again.
Yes.
Well, that's the thing, isn't it? To some extent, as the Norwegian sovereign wealth fund is finding, you are the market. Even if you think that you'd like to be out of it, where can you be? Now, here's another topic that we've covered a few times: the issue of flows in markets. The idea that for every buyer there must be a seller. The FT has highlighted a paper by Xavier Gabaix. Sorry, I'm be gabbling that name. And Ralph Cohen of the University of Chicago on a very interesting paper that is available on the Social Science Research Network. And this looks at pressures within the equity market, pressures that arise from mandates that pension funds and investment funds of all types have. So you might, for instance, have a 100% equity fund and another fund, say, a retirement fund that's fixed at 70% equities, 30% bonds, etc. And what this paper does is imagine there's a flow into an equity fund, a flow, for instance, from cash, further savings from in a pension fund, perhaps. And what implicitly is that fund doing? It has to buy equities. That's its mandate. So it will go out and buy equities. And if it, for instance, buys those equities from a fund that has a different mandate, say a 70-30 mandate, the fund with the 70-30 mandate would only sell that stock, that equity, to the 100% equity fund at a price which enabled it to preserve its own 70-30 ratio. So it would only sell equities at a much higher price. So you get a very disproportionate effect of inflows causing rises in prices from mandate pressures. Now, this is not supposed to happen in the theoretical world because you're supposed to have value arbitrageurs who will say, aha, this is nonsense, we will bet against this. But most people these days, of course, are not value investors. Hedge funds, if anything, are more momentum investors. Now, this wasn't part of the paper, but I wonder whether the same thing is happening in bond markets. We have buyers who are price insensitive, i.e. central banks. We also have situations like pension funds with liability matching mandates. They buy and they're very price insensitive. Now, that pressure of a forced transaction in a world where many funds have fixed mandates is what's causing this disproportionate pressure on prices from modest changes in flows.
Thank you, Stuart. That's really interesting. I hadn't seen this paper, but I was aware that there is an increasing portion of the market that is held by price insensitive owners. So as index funds become a larger portion of the market, they just don't care about the price. And as you point out here, you get these structural reasons there, these structural pressures to forcing the price up. There are fewer people in the market to take advantage of that and to push back, to rebalance the market and get proper price discovery.
Yes, that's exactly the issue. And what I didn't mention was the title of this paper, and it's called the Inelastic Markets Hypothesis. There are not ready flows of buyers and sellers. It's a very inelastic response to changes in pressures. Here's something I came across as I was looking for some ideas for this week. This was the idea that I was a dinosaur and completely unaware of what's happening in the world of social media. So I had a look at, who are the world's most popular social networks. I was pleased to discover that I was, in fact, aware of the top 5, Facebook, YouTube, WhatsApp, Instagram, etc. But looking further down the list, there are more Chinese social networks that I was not aware of. QQ, for instance, that's Tencent's platform. It covers everything: games, shopping, messaging, etc. There's Douyin, I probably mispronounced that, which is a sort of brief TikTok type video thing. Now, what most struck me actually was the lack of a Japanese name in all of this. This is they've really been left behind in this world. I was sort of hoping that Facebook had peaked and that it was only sort of grandmas who are using it these days. I'm totally wrong. The chart goes from bottom left to top right. the number of monthly active users is still shooting for the stars.
Interesting, but we don't know how many of those are just accounts that need to be set up so you can log on to various things that Facebook now owns. There are various other apps which won't allow you to join unless you have a Facebook account, I believe.
Yes, and I've heard stories from friends around the world who want to, even buy a delivery McDonald's, and you have to have a Facebook account. So they're getting their tentacles into everything. This was another thing which struck me. I saw some headlines talking about the wonderful fall in carbon dioxide emissions last year during the COVID pandemic. I'm afraid my take on it was much less positive. If it takes a pandemic to reduce carbon dioxide emissions by just 7%, that really shows the extent of the action that we need to take to resolve this. I mean, you would need, in a sense, a pandemic level reduction in CO2 emissions of this magnitude 15 years running to get the emissions reductions that we all need. Again, trying to sort of get a sense of the scale of change. Here's a chart showing the number of battery electric vehicles in use. Now, this is not the amount sold. This is the cumulative stock of electric vehicles, which has now reached 6.8 million. Comparing that with the fact that there's about 70 million cars and 2 million trucks sold each year. And there's obviously a huge stock of accumulated cars and trucks from previous year's sales. This shows how far there is to go in this area of emissions. This chart, I think, is always interesting to pay attention to, which is the level of margin debt versus the S&P 500. And just to note that the margin debt is recalibrated into present day dollars. There has been some press coverage about how margin debt has been falling, which you can see in the very right-hand side of the chart. But my goodness, it's still massively elevated. And to me, this is more evidence of speculative excess. And we see that obviously with SPACs and NFTs and all the other stuff.
Yeah, and just look at the blue line, the S&P 500. I mean,
it's phenomenal. Yeah. Now, here's a few slides on another topic that's got my interest, which is, there's a danger here. A little knowledge is a dangerous thing. But I've been looking at UK commercial property, and here's a chart showing rolling 12-month take-up of central London property versus availability. Now, unsurprisingly, from the first quarter of 2020, we see take-up dropping away, and we see availability massively increasing for all the reasons that I'm sure everyone will be aware of. So the fundamentals look decidedly dodgy, and yet the performance of property is surprisingly strong. Here's the MSCI monthly UK property index, where we can see in the latest data points on the right that it's onwards and upwards. And another version of telling the same story is the prime office yields. And we can see here in the red line that yields have been flat to slightly falling in the UK, and in Western Europe in general, they've continued falling massively. So obviously as yields fall, prices rise, and this just struck me as a very big disconnect compared to the fact that surely the future of offices has got to be in some doubt, at least at current prices. And this is something, of course, not at all reflected in the price of UK REITs. Here's a chart showing the iShares UK Property REIT, and you can see that it has reached pre-COVID levels when the FTSE 100 itself has not recovered. So property has done better. Turning from the commercial property market to the residential property market, here's a chart from the Resolution Foundation that I found quite surprising. What they've been looking at is the performance of UK residential property banded into quintiles, where the lowest quintile is that of properties of highest value, where the stamp duty saving as a proportion of the value of the house is lowest, up to houses where the savings from the stamp duty holiday are largest, which are shown in the more tan and brown colours. And here the outcome is actually rather unexpected, where it's the highest priced houses with the lowest saving from the stamp duty holiday which have done the best.
So what you're saying, Stuart, is that the stamp duty holiday was a pointless waste of taxpayer money.
Yes, it's much more behavioural. People wanting to get more space and get out and use their furlough money, or use more likely low interest rates to change the structure of their life. Taking at the 30,000 foot level, I've shown here the OECD's economic forecast. So this is basically GDP growth and some other salient economic stats. And what we've highlighted here is basically for 2022, the OECD's economic forecasts pretty much across the board are very positive. So overall for the world, 4.4% growth next year. And within that, the developed markets, 3.8%. So implicitly emerging markets doing better, much better than that. So a surprisingly strong number, a continuation of the bounce back from this year, and to some extent sort of return to better than pre-COVID levels.
Absolutely. Thank you, Stuart. And building on that last chart from Stuart, I just wanted to quickly recap where we are in the economic cycle, because we have had a couple of months in which the reflation trade has done incredibly badly. So commodities have all come off heavily, and long-dated bonds perversely have gone up. Their price has gone up, their yield has gone down, despite rising inflation, and inflation prints well above expectation and central bank targets. And just to recap where we are, and building on what Stuart's just said, I think we're at the start of an economic cycle, and the reflation trade and cyclicals is precisely where you should be at this point in the cycle. Although obviously those stocks and that trade has done very badly over the last 3 months. So I think we are at the start of the growth phase of a long expansion, essentially. And these couple of charts on inventories caught my eye, because they show inventories are at absolute rock bottom. And that is great, because that means that factories are going to have to work at full capacity to restock. So this is for the US, and you'll see that the only time inventories are this low is at the in a recession, and when we're coming out of it. And this is for the UK, where companies are reporting their lowest stock levels since records began. Okay, some other charts. I thought, again, just to briefly recap where we are, this is a chart from Lynn Alden, which shows the inflation and rates for the US. So producer price inflation is running at 7.8%. Consumer price inflation is running at 5.4%. But the 3-month Treasury rate is at 0.05%. So monetary policy is extraordinarily stimulative, and bond yields are all well below inflation.
Keith, I don't know if you read Merrin Somerset Webb in the FT, but she had a nice phrase a few weeks ago talking about this as basically being an inflation tax. You've lost 5% of your wealth.
Absolutely. And we've talked constantly on this podcast about how central banks are essentially trapped, and because of the high debt levels. And the only way we can get rid of high debt levels is to inflate them away. What we'd expect to see is central banks not doing anything while constantly talking about raising rates, and so keeping the confidence of the market while quietly allowing inflation to erode the value of debts. And that's what we're seeing. Now, I thought this was an amusing chart, and building on our earlier discussion about Chinese defaults and how much you can trust the Chinese. These are Chinese coronavirus deaths, and they haven't had any in 18 months, like zero. Anyway, so there you go.
Yep.
fiscal stimulus continues apace in the US, and bear in mind that the Biden administration is in discussions for a multi-trillion, we're talking about, I think, $3 trillion budget. But one thing they have passed is a $1 trillion infrastructure bill. And apparently only about 10% will actually be spent on infrastructure. But this is a chart showing when you can expect to see the fiscal flows from the infrastructure bill. And that is not until 2023 in the main. So that won't really impact next year. And I thought this was an interesting chart of the most heavily indebted countries in the world. And number one is probably, as you would expect, Japan, which has been running enormous fiscal deficits for well over 20 years now. But I thought number two was very interesting, Canada. Stuart.
Well, Keith, I think there's a housing boom quietly gone on in that country. I was supposed to emigrate there once at one point. I bought a house with an obscene price, decided not to emigrate, sold it at obscene plus quite a bit, very happily. And then I've probably seen it go to the moon since then. It's just an extraordinary bubble. And obviously, everyone's worried that it's unsustainable and a crash is coming.
After that, Greece, and in number 4, just outside the medal position, it is the UK. Not great. Not a table you want to be appearing high in.
Keith, just to add one further sort of depressing comment to that is that's a chart of debt to GDP. It doesn't even look at the asset side of the equation, where some countries do have some sensible assets to offset the debt. Whereas I think in the UK, we've got much less of that, having sold off the family silver.
Yes. And regular viewers will know I've had a very bad time recently as oil companies and commodity price stocks have all sold off as the reflation trade has done very badly over the last couple of months. Well, I'm in good company because hedge funds have done very badly. Their assets liked by hedge funds have all had a very bad couple of months. And this is a chart of Fed ownership of the US Treasury market, and it's astonishing. They now own over 50% of all bonds with a 10 to 20 year maturity. And the question I would have is, how can you correctly value an asset where there's a guaranteed buyer who is price insensitive? And now the Fed is talking about tapering. I wonder where the market will find balance when the guaranteed buyer of last resort disappears. And more on the market insanity. This is the number of SPACs, the value of SPAC mergers, and it continues to rise. You will have seen that Richard Branson has another space SPAC, and he was talking about bringing it to market at a valuation of 1 billion at the beginning of this year. Well, it looks like he's going to bring it to market at a value of 3.2 billion.
Yeah, pick a number out of the air.
Yeah. And finally, I thought this was an amusing chart, and this shows, so what is ESG? There are 3 companies that rate stocks according to their ESG criteria, and you can do a correlation between the 3 of them, and what you find is they don't correlate very well. So nobody can quite agree on what makes a stock good on environmental or social or governance criteria. In the environmental criteria, for example, the correlation between the MSCI and Sustainalytics is only 0.3, so not great. Okay, and finally, COVID. So last week we talked about Israel and how Israel, despite being the country which has the best vaccination record in the world was seeing a big spike in cases and hospitalizations because of the Delta variant. And we discussed last week how an explanation was that vaccinations tended to be less effective for the elderly and the more vulnerable. However, there was a good article in the FT this week which appeared to show that the Pfizer-BioNTech vaccine in particular suffers from rapidly declining effectiveness. So this chart shows how effective the vaccine is over time. And you'll see that the Pfizer-BioNTech vaccine is more effective than AstraZeneca initially, but then after about 4 months, it becomes less effective than AstraZeneca. And this is the important chart. And this is data from Israel. And it shows the cases per 1,000 population according to A, whether they've been vaccinated, B, if they've been vaccinated, when they were vaccinated. So you'll see the highest infection rate is amongst the unvaccinated, but then the effectiveness of the vaccine drops quite quickly. And you'll see here that sadly, that means that the case rate has been rising in amongst the vaccinated almost as quickly as amongst the unvaccinated. Now, the good news for us in the UK is that it looks like the AstraZeneca vaccine has been much more effective at keeping hospital admissions low than the Pfizer-BioNTech vaccine, which they mainly used in Israel. So if you look at the Israeli chart, you'll see that the number of hospital admissions has been rising in line with cases, and in the UK, that has not been the case. And in the US, Bank of America is forecasting that we should be soon seeing or have seen the peak of the Delta virus infections, which is all good news. Stuart, do you want to talk through equity markets this week?
Sure. Generally very positive. Most markets up between 1.5% and 2%, with surprisingly the FTSE All-Share, the UK, taking top spot for once. Bitcoin had a weak week, down about 4%, but we don't need to cover that as Richard isn't here. And the pound continued to weaken slightly, now at about 137 to the dollar.
Okay, moving on to commodities. And it was generally a very strong week with commodities bouncing back from a big sell-off last week. So aluminium up 2.5%, cobalt drifted off slightly down 2.1%, copper bounced back strongly up 4.5%, chromium was flat, iron had a huge bounce from its recent sell-off up to 8.2%, lithium was flat, neodymium was flat, nickel bounced slightly up 1.6%, ferrovanadium drifted off down 1.4%, but energy had a big bounce from a big sell-off last week. So WTI was up 10%. Natural gas was also up 10%. That's the Dutch natural gas future. Coal continued its relentless climb, up 1.9%. And uranium continued its recent climb, up 2.8%. Now, last week, there was a big sell-off in oil, which was attributed to fears of the Delta variant reducing mobility and the demand for oil. Well, all the data from the US shows that actually that did not happen. The US demand for oil actually rose last week. And as a result, oil and petroleum inventories in the US have continued to decline and now well below their 5-year average. That's all very bullish. And if you look at world inventory levels, they are also dropping and are also below the 5-year average. Now, aluminium. You recall from previous weeks, we were talking about how aluminium is forecast to move into deficit this year after years in surplus, and it's continuing a relentless rise. Cobalt is just off its highs. Copper seems to hopefully have found its level after the big sell-off last week. Iron ore has had a bounce, but that's been a big sell-off, which has seen the price come down by about 40% in just a few weeks. Nickel is seems to be finding a level, I think. Ferrovanadium is climbing once again. Crude oil has bounced back. And as long as we see inventory draws, you'd expect crude to be strong. Now, I thought this was interesting. Dutch natural gas prices are climbing strongly. And I saw during the week a chart which purported to show that storage levels in Europe are well below normal for this time of year. And we are building up for a winter crisis unless we get a big increase in gas supplies in the second half. And coincidentally, today I received a notification from my energy supplier saying they were going to raise my energy bills. So this is going to squeeze household budgets. And coal continues its relentless rise, and uranium's going up.
So turning to precious metals, gold had a reasonable week, up 1%, silver up 2.5%. Platinum and rhodium, however, were weaker, particularly rhodium down 6.5%, and palladium was up 6.6%. And looking at that in chart format, here we can see gold, in a sense, trying to find some clear direction. People like me concerned by monetary chaos still have interest in it. And you would think with inflation rising and rates remaining so low, the fact that real interest rates were therefore very negative would be supporting it. But it's not showing any great uptrend. Perhaps people are just desperate for nominal yield. Now, this, I think, is interesting as a contrarian signal, at least. This shows the Global Junior Gold Miners Index, which has been distinctly weak, falling from almost a 1600 index level to about 1000. And looking at that from a technical perspective, the percent of members above their 200-day moving average has reached a low that suggested a bounce back in 2018 and 2020. And now, this is actually of interest to me because my latest purchase has actually been of a gold mining ETF, because I see the gold miners a bit like the oil stocks. There they are, every day that the gold price remains at a reasonable level, they're earning their revenues, they're generating their profits, and hopefully will be paying out decent dividends and maintaining some capital discipline. So the fundamentals seem pretty good. Plus, there's the insurance aspect, if we do get to monetary chaos, of them being backed by gold, and yet the stocks are deeply unloved. So I see this as a sort of interesting contrarian play, and I'm gradually averaging into some gold miners. Here's silver. Perhaps if you were a short-term chartist, you'd say it had reached a valuation bottom, just under $24 a troy ounce, seemingly in a range between 24 and 28. Platinum, in fact, the whole PGM complex is suffering a bit from the problems with car makers cutting back production because they can't get the semiconductors, and that, of course, impacting demand for platinum, palladium, etc., for the catalytic converters. So here we are, platinum off from a peak of 1,300 down to 1,000. Rhodium from 28,000 to 17,000. And palladium from almost $3,000 a troy ounce to 2,400. So weakness across the board there.
Thanks, Stuart. And finally, rates. Well, quietly, we had a sell-off in the bond market and rates rose across the board. So you see the UK 30-year is now back above 1%. having risen almost 9 basis points last week. But when you look at it on this chart, I mean, the sell-off was quite mild, and we are still a long way from the yield highs back in May. And similarly, there was a sell-off in US Treasuries. Finally, if we look at the seasonality chart was slightly let us down in August, but coming into September, we are looking at 2 of the traditionally weakest months of the year, and I have some spare cash which I'm looking to put into the market, and I am very much sitting on my hands. I see the very elevated valuations in the US, and I think at some stage we have to have a tech sell-off. Just the number of companies with a price to sales ratio above 20 are just absolutely ludicrous, and at some stage this has to end. When you look at the shape of the graph of the NASDAQ and the S&P 500, it just can't continue. And when anything can't continue forever, at some stage it stops. Okay, let's talk about Stuart's portfolio.
Thanks, Keith. So year to date, I'm doing reasonably well, up 10.5%, which I would put down mostly to the fact that a lot of the stocks that I hold have reasonable dividends. They started the year on reasonable, respectable yields, but this whole chase for yield has pushed up the price of things like that. So although good performance year to date, I'm much more cautious going forward. In terms of portfolio activity, last time I was on, I mentioned I was just about to buy into a new IPO, UK residential REIT, but it didn't happen. It was not sexy enough by far. Space investment trusts, yep, they can take off, but residential REIT did not. So I wasn't able to do anything there. More generally, I've been paring back winners. I've had quite a good run with some of the warehouse REITs, companies like Tritax, Big Box, and literally Warehouse REIT. And I can't believe the levels they've got to, so I've been paring them back. I've been building up cash with the proceeds, plus, as I mentioned just now, I've been buying, beginning to nibble into some gold miners each month.
Very good.
Keith asked me to present on what my overall asset allocation was, and this is within my SIPP. It's a bit different from a traditional setup, and that's partly because of the tax status and structure of a SIPP. I've used it quite often for income generating assets, so it can avoid the high rate of income tax than capital gains tax. But I'd also point out to viewers and listeners to have a think about property income distributions. These are treated very favorably in a SIPP. It basically means that you're getting pre-tax profits from REITs passed to you. They're in effect completely tax-free. So normally a company's earnings would be taxed, and then from the taxed earnings, you would have a dividend paid out. But from a REIT with its property income distribution, there is no tax taken before the dividend is paid out, and the REIT has to pay at least, I believe, 85% of its earnings as a dividend. So REITs, I think, are particularly well suited to a tax exempt structure like a SIPP or an ISA indeed. So based on that, I've got about 30% of my SIPP in various REITs. I've got about 16% in regular equities. This is basically world ex US and done via ETFs. I've got about 7% in some infrastructure trusts. By trust, I mean an investment trust, very simple, quoted on the stock market, as easy as anything to buy. Often they have RPI linked revenue agreements with governments to provide things like roads or hospitals or schools or prisons indeed. So they're a sort of quasi inflation protection. I've got some secured lending trusts. They come in about 15% of my portfolio. So this is sort of asset-backed lending. Though, mind your eye, I did do a My Worst Trade episode on one of these, which went horribly wrong. I've got an emerging but growing bet on commodities. This is basically gold and gold miners. That's only about 4% of the fund at the moment. I've got just under 10% in green energy income trusts. Again, quoted on the stock market. We mentioned them before as benefiting from the recently rising gas price and also benefiting from inflation-linked government green subsidies. They pay about 6% a year and have been growing typically, a couple of percent every year. I've got, again, a short 10% in UK prefs, and I've got 10% in cash, waiting for a better buying opportunity. As I say, a lot of the things that I invest in do have a high income component, and that's been chased up so much that the yields available now are that much less attractive. So I'm trying to take some money off the table.
Well done, Stuart. Your portfolio is both lower risk and higher return than mine. So well
just
done.
Just for now. Yeah, things will change, Keith.
So after that highlights of Stuart's outperforming portfolio, the lowlights of my own. Well, I bounced back last week, up 2.7%, I estimate. But that brings me up to 2.3% on the year, which is desperately disappointing, underperforming Stuart, Richard, and the All Share. I bought one stock last week. I bought some more Harbour Energy, which has a gas field, the Tolmount field, which is due to come online in Q4. And as we've seen, gas prices are very elevated. So if the much delayed gas field comes online, according to the revised schedule, it will come in just when gas prices are very high, which would be great. A couple of stocks we've discussed. So last week I talked about Hunting, and unfortunately Hunting had its annual results this week, and they revised down guidance so that they're expecting 2021 revenues to actually be below 2020 revenues, which is below their previous guidance and disappointing. And the share price has done quite poorly, but I expect it to recover with the oil market. And finally, a stock that we have discussed occasionally on the weeklies, Helium One, which is popular with private investors, but we briefly discussed it because it had an absolutely extraordinary market cap for a company which actually had yet to prove that it actually had any helium. Well, they did the drilling this week and it wasn't good. They didn't find any helium. So the share price absolutely cratered. But even after the big falls this week, and it's fallen by what, 2/3, the market cap is still 56 million. So you wonder whether there's still further to fall, and just goes to show the dangers of investing in these small exploration and development plays. Okay, I think that's it for this week. Thank you to everyone for watching through to the end, and in particular to Stuart Owen for stepping in for Richard. Thank you, Stuart.
Not at all, very happy to.
So I hope you all press like and subscribe to the channel, and it's goodbye from Stuart Owen.
And goodbye from Keith Jordan.
Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website. including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.